Your agency's revenue is lying to you. The accounting mistake killing your profit and cash flow. Hi, I'm Cody. I'm a CPA, and we work with marketing and PR agency owners who want better cash flow, stronger profitability, and smarter tax planning. Today, I want to talk about one of the biggest accounting issues I see inside growing agencies. The agency looks successful on paper, revenue is up, the team is busy, clients are spending more, but cash still feels tight. Profit is not where it should be, and the owner cannot figure out why. A lot of times the answer is simple. The agency is looking at gross revenue instead of agency gross income. And that one mistake can distort almost every financial decision you make. So you've heard me before say, gross revenue is a vanity number. A lot of agency owners like to lead with the top line revenue. They'll say, we're a $3 million agency. We're on track to hit $5 million this year. But for a marketing agency or a PR firm, gross revenue is a vanity number because not all revenue is really yours. If a client pays you for media spend, that money may pass right through your agency. If a client reimburses you for printing, production, outside vendors or freelancers tied directly to delivery, that money may not be available to run a business. It hits your bank account, it may show up in your accounting, but that does not lead to profit. And it does not mean it's cash you can use freely. That's why I believe agency owners need to focus on agency gross income. Agency gross income is the money left over after you remove your pass-through costs and your direct delivery costs. It's the money that the agency actually has available to pay the team, cover your overhead, invest in growth, and produce your profit. That's the number you should be managing. Not just gross revenue, but agency gross income. Pass-through revenue can distort your profit. And here's where it gets really dangerous. Let's say a client prepays your agency $100,000 for media. That money hits your bank account, but most of it's going back out the door to Google, Meta, LinkedIn, or some other media vendor. If your books show that full $100,000 as revenue, but the expense has not yet hit, your profit is going to look inflated. You may look at the P&L and think, we had a great month. But in reality, you're holding client money that still needs to be spent, and that's not profit. That is not cash flow you can depend on, and it should not drive your hiring, your pricing, or your tax decisions. And this is how agencies get into trouble. The owner looks at the financials and sees a big revenue month. Then they hire, or they increase their spending, or God forbid they give raises, or they assume they can afford a new tool, a new role, or a new contractor. Then the media spend goes out the door. And suddenly the cash is gone. The agency did not have a profit problem. It had a reporting problem. Pass-through dollars need to be handled very carefully. In many cases, money received for future client spend should be tracked on a balance sheet until the expense is actually incurred. Then the true margin becomes clear. Maybe you earn a management fee. Maybe you mark up the media. Maybe you charge a fixed advisory fee. That's the margin that matters, not the full amount that passed through your account. Because if you confuse pass-through money with agency gross income, you're not managing the agency, you're managing an illusion. Point 3, bad accounting creates bad tax planning. These decisions also affect your tax planning, and this is where agency owners can end up frustrated. If your books show inflated profit because pass-through revenue is sitting in income without the matching expenses, your tax estimates may be too high. You may be sending money to the IRS based on income that is not really income. Or the opposite can happen. Expenses hit later, and we see this so often when people receive prepayments in December. Revenue timing is off, receivables will build up, deferred revenue is not tracked correctly, and now your tax picture does not match your cash flow. And this is why agency tax planning cannot be done once a year. It has to be connected to monthly accounting, especially if your agency is filing your taxes on a cash basis, but manages the business on an accrual basis. And that creates another layer of complexity. You may have strong accrual profit, but the cash has not been collected yet. Or you may receive a large payment in one year for work that is delivered later, and that can create a tax issue if it's not planned for. And most agency owners don't need more tax surprises. They need better visibility before the year end, and that starts with clean monthly financials and a real understanding of agency gross income, and it should also include a monthly accrual to cash conversion. Point 4, your accounting should help you make better decisions. Clean agency accounting is not just about tax returns. It's about running the business. Can you afford to hire? Can you add another account manager? Can you invest more in AI? Can you take on a large client without hurting your cash flow? Can you move from production type work into advisory work? Can you afford to carry a slow paying client? And you can't answer those questions if your financials are messy. You need a profit and loss that separates agency gross income, cost of goods sold, direct labor, contractors tied to client work, your overhead, and net profit. You also need to know your AGI per full-time equivalent. That number helps you understand whether your team is producing enough value relative to your headcount. And as AI changes agency deliver, this is going to become even more important. Because if AI helps your team deliver work faster, that should show up somewhere. It should improve your margins. It should increase your capacity, and it should help your team focus on strategy, advisory, measurement, and outcomes. But if your accounting does not track delivery costs correctly, you're not going to know whether AI is improving profitability or just helping your agency do more work for the same money. And that's a dangerous place to be because AI should increase your margins. If it only increases your client expectations, the agency has a pricing problem. Let me ask you this. When you look at your agency financials, do you know your real agency gross income? Not your gross revenue, your agency gross income. Not the deposits, not your billings, your actual agency gross income or AGI. Drop it in the comment below because I read them all. Point number 5 is future-ready agencies need future-ready numbers. The agencies that are going to win over the next few years are not just going to be more creative, they are going to be more financially disciplined. They will know which clients are profitable, they will know which services produce margin, they will know when a retainer is underpriced, they will know whether AI is increasing profit or just increasing the workload. And they will understand the difference between being busy and being profitable. And that is especially important as agencies move towards advisory work. Clients are not just paying for hours anymore. They're paying for outcomes, strategy, speed, judgment, measurement, risk reduction, better decisions. But if your internal accounting is still built around the old production models, you may price your advisory work incorrectly, you may undercharge for strategic value, or you may keep selling deliverables while your best opportunities are in higher margin guidance. Your accounting system should help you see the business clearly, not just file your taxes after the year is over. You want monthly financials that help answer, what is our real agency gross income? What are our people costs as a percentage of AGI? And remember, 55% is the goal. What is overhead as a percentage of AGI? Remember, that's 25%. Which clients are creating the most profit? Which services are dragging margin down? What cash is truly available? What tax exposure is building? That's how you run an agency like a business, not just a collection of projects. So let's recap. First, gross revenue is not the number to run your agency on. Agency gross income is the number that matters. Second, pass-through revenue can make your agency look more profitable than it really is if it's not tracked correctly. Third, bad accounting creates bad tax planning. If your financials are wrong, your tax estimates may be wrong too. Fourth, your accounting should help you make decisions during the year, not just prepare tax returns after the year is over. And fifth, as AI, advisory work, and new delivery models change the agency business, your numbers need to keep up because the agencies that survive the next wave will not just be the ones that sell more, they'll be the ones that actually understand what they actually keep. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, in building a more profitable agency. I'll see you in the next video.